Hi, it's Brian Decker with your Market Minute. Wanted to talk about some of the tweaks that we've made to the portfolio this week. We announced that we've taken the mutual fund manager, the NASDAQ mutual fund manager, down to half the allocation, down to about 8%. And we've dramatically increased the ETF tactical manager from 16% to 40%, going from 2 ETFs to 9 for 3 important reasons. One, we were able to further more broadly diversify the portfolio. That's number one. Number two, we've been able to dramatically reduce drawdown. The manager, the ETF, the NASDAQ ETF, the NASDAQ mutual fund manager had a 40% drawdown that just has really bothered me for years, and I didn't have an option until recently. So we jumped on it and we changed 40% drawdown, which is the largest peak to trough drop in the history since inception for that manager. The NASDAQ has a 70% drawdown, but still 40% is too much for retirees. And so we were able to cut that to about less than half that. So that's a good thing. Less risk, more diversification, and then number 3, this is the biggie, higher returns. Average annual returns for the NASDAQ mutual fund manager has been 24% since inception in 2005. The tactical ETF, 9 ETF combo that we put together is now got average annual net of fee returns of pretty close to 30%, 29%. And so we're happy about the changes. It's rules-based, it's computer-driven. Average annual returns are far more than the benchmark indexes, and for both the NASDAQ, the S&P, and gold and silver indexes. So we're happy about the diversification of the portfolio. We're happy that it's two-sided, that it's rules-based. Oh, another important thing is we're able to lower whipsaw. Whipsaw is when a trigger has a change where we go from long to short, and then we go back long again because the trend change had no follow-through. That's called whipsaw, and it costs performance, and it's part of the fact sheets that we send out. We're able to reduce whipsaw because the ETF tactical manager only goes short in one of the 9 portfolios. The others go to cash, or they use stop losses, or they use relative strength to buy whatever's going up. For example, in 2000, 01, and 02, when the S&P lost 50% and the NASDAQ lost 70%, there were several sectors that were still going up during that 3-year period. Gold, silver, energy, healthcare, biotech, pharmaceuticals, those were all going up, and real estate. Those were all going up when the markets were dropping. So this is a rules-based, math-based approach to the markets. Now, the first 4 months of this year were pretty flat, and so this is a 20-year program. Don't be discouraged that we can't have 4 months of flat when the markets have not been trending. Look at the pattern for gold and silver so far this year. They haven't been trending, and the NASDAQ has had some big pullbacks. So we have not produced the big returns. But in most years, there'll be 5 different months of the year, of the 12 months of the year, where the big numbers are put up. So look at the fact sheets that are there in the weekly risk email that we send out each Monday. Study those and let me know of any questions. Hope you have a great week.